My friends, I typically don't do this, but I'm gonna give you some investment ideas right now. 10-year treasuries 2.19. I just saw Dow was up 500 points today. All right, the reason Dow is up because the Fed, my man Jerome Powell, the chairman of the Federal Reserve Board, said they're looking into cutting rates. All right, so remember the Fed funds rate, the Fed controls the short-term rates. The 1 month, basically, you see, if you look back throughout the last 30, 40, 70, 90 days, roughly about 2.5, 2.4, stayed flat. What you'll see as you go out further on the yield curve, the rates are volatile, just dropping like a brick in water. So the Feds do not control intermediate to long-term rates. They control the short end of the stick. All right, so what does that mean for you? I'll share with you in just a second. Got to hang tight. All right, so as the Fed is thinking about cutting rates, I mean, they're saying, we're kind of concerned recession is pending, and like I could care less. We get recessions all the time. It doesn't matter. I mean, it matters if you lose your job. That's why you always want to have some cash on the side. What it matters for your investments, though, means that the treasuries have jumped up like a bat out of hell, the prices. So you can probably now assume that if the Feds start cutting rates on the shorter term, what does that mean for the longer term? That means it's probably a good time to maybe get rid of some of your treasury bonds and move those out. Simple facts are, if they control the short end and they're thinking about cutting, I bet you're going to start seeing the shorter end of the yield curve dropping, which means your shorter term CDs are going to be paying less and less and less. So what I would suggest is now it's probably not a bad time to move from treasury bonds, all right, especially long-term, intermediate terms, and move them suckers to short-term CDs. Excuse me. The reason for that is because you're getting gains. You have gains on the table from your bonds. There's no other way around that. Now, I don't like bonds. You should never own bonds. But if you have bonds, now is probably a good time to move those out. Take your gains and lock them into short-term CDs. I'm telling you right now. I don't know. I could be wrong. But if the Fed is worried about recession, and the bonds have already been priced in. All right, the price of the bonds have already been priced into the basket, the cake here, because the yields on bonds are so low. I mean, the 10 years at 2.1, my friends. The 30 years at 2.5. All right, I mean, even if we get an official recession call, and that always happens after the fact. Usually they call it recession when we're already rebuilding again. In fact, that's what happened. That cost George H.W. Bush, Perot, and the fact they called the recession. That's what caused him. I mean, by the time Clinton won in 1992 with 43% of the vote, everyone was convinced we're already in a recession. We had already escaped from recession 6 months previous. June was when we got out of the recession, so the recession that the media was harking on simply did not occur like they had told us. I mean, it did, but we're already well out of it by the time the election came. And that's the way it always is. They always call the recession 3 months after the fact because they're backwards looking. All right, they're not leading indicators. They're what's the opposite of lead? Whatever. So you got leading indicators, which shows the future. The indicators from the past. I forgot what the term was called. Man, I can't believe I can't remember that. I studied that in economics. But anyway, something indicators of the past. And the past doesn't mean anything because the leading indicators are what matters. So anyway, when they call the recession, it's usually too late. The recession's already happened. It's usually already passed us by. We're usually back into growth. All right, so now if the Fed says, hey, we're going to lower interest rates on the Fed funds rate, that just means the short-term stuff is going to drop, CDs, savings accounts, whatnot. Now, but Josh, doesn't that mean the longer-term rates will continue to drop because there'll be a huge demand to those bonds? The demand's already baked into it, man. I'm just telling you right now. You already have this inverted yield curve. You already have a flat yield curve. The demand's already there. So the price of those bonds are already there. If they start dropping the rates, what's going to have, you'll have a lowering of the short end of the yield curve. And then what's probably going to happen is people start selling their long-term bonds, thinking, hey, all right, the Feds are taking action. They're going to flood with the liquidity, flood with low, easy money again. Let's go back into stocks to deal with the inflation that is inevitable when the Fed is loose with their money supply. Look, I don't know if it'll happen, but you can see this a mile away. Say, okay, the Fed gets loose with the money supply. What's the biggest concern people have? Inflation, without question. Without question. What's the price? Oh, there's deer running across the street there. Deer, the rats from my garden. So what's the worry about right now? We're inflation. Oh, not inflation, a recession. Recession is the opposite of inflationary, so everyone is looking at long-term bonds and buying them up to deal with what they think is a pending recession. So they're going to buy these guys up, the yields drop, the prices go way up, and now you got time to sell those suckers and take the gains and put them in, lock in your short-term CDs before the rates go down. Rates haven't gone down yet, but they're gonna if the Fed calls it. You will see the short-term rates on CDs and money market accounts and savings accounts drop like a brick. So then you say, okay, well, I can do that, or I can just lock my gains in from the bonds and move that to stocks. Stocks have been hammered quite a bit the last, 45 days or so. You can do that too. Because what happens in inflationary economies, and when the Fed gets loose, that's inflationary, people sell their longer-term bonds. Intermediate long-term bonds are not profitable in an inflationary environment. It's the worst possible place you can be. Inflation and taxes will eat up all your gains. You're not making any money, but yet you're locking up your money for 10, 15, 30 years. Don't do that. So it's okay. Loose Fed, we know that what that'll mean is interest rates will be dropping. That means on the short end, I could probably lock in a decent rate for a CD right now. Be done with that side of the barbell. Take the other gains and put it in stocks, recognizing for sure that you don't know on any given day, but we know in a loosening of the interest rate, loosening of the currency of the Fed, that usually is inflationary concern. Stocks deal with inflation, bonds hate inflation, and thus you're going a perfect time to lock in both sides of the barbell. So anyway, look, I don't get the market time. I'm not doing anything. I just got VTV and I'm done with it and just let that sucker ride. But if you're looking to maybe time the market a little bit, you're looking to prepare for retirement a couple years out, man, this is not a bad strategy to consider. All right, we'll see you guys next time.